The concept of risk and return means that higher returns require higher risk. The capital asset pricing model describes the relationship between risk and return for different assets over time. The horizontal axis shows risk or variability. The vertical axis shows return, and the diagonal line illustrates how risk increases as return expectations increase. For example, U.S. Treasury bills are a very safe and secure investment. They require little risk but have lower returns. Venture capital, which involves investing assets in a startup company, has higher risk because the new business could fail. But if the business takes off, the return is larger than other investments. Now, the relationship between risk and return isn't always this linear. Looking back over the last 30 years, you can see that the risk-return ratio of each asset class doesn't change much compared to the other types of assets. For example, government bonds should always carry less risk than real estate investments. But you can see that the returns for each type of asset vary over time and will not always land on the line. Even in the course of just a few weeks or months, they can change, and you may get more or less return than expected. But the long-term concept remains intact. If you want additional returns, you'll have to take higher risk over time. We can even go all the way back to 1926 and look at the long-term return graph for stocks. You can see this relationship between risk and return really paying off, though there are some stretches that were tough to tolerate. Historically, it's important to see that you can have several years in a row of substantial negative stock returns, like from 2000 to 2001. In both of those years, stocks were down 10 to 20%. In 2008, stocks were down 40 to 50%. But you can also get some annual periods, like 1997 through 1999, when we saw tremendous returns of 25 to 35% from the stock market. So if you're just starting a portfolio and investing in stocks, you may catch a really good year, or you could potentially have a bad starting year. It's important to remember these long-term trends. We can take this one step further and measure variability using standard deviation. Each asset class has a standard or average rate of return, and it can be expected that the asset's actual return per year will deviate from the average within a certain range. Riskier investments will deviate farther from the average than safer investments. Let's take a look at stocks again. Since 1926, the average return is 9% a year, which includes a 3% inflation rate. One standard deviation from this 9% average is 18% in either direction. In other words, in some years, stocks return as much as 27% or lose as much as 9%. About 66% of stock returns fall within this one standard deviation. Two standard deviations from the 9% average adds an additional 18% in either direction, which means that in some years, stocks could return as much as 45% or lose as much as 27%. Approximately 95% of stock returns fall within two standard deviations of the average. The same kind of data is available for bonds, but bonds have a lower average return of 6% annually, and one standard deviation is only plus or minus 12%. This is another way to prove that bonds are less risky than stocks. Since the levels of risk and return vary with each type of asset, most institutional investors diversify their portfolios to manage the risk. It's helpful to evaluate your fund's own risk tolerance and determine which combination of asset classes might best meet your needs.